hand over to Sam now. So quite a complex subject, but Sam will do a great job explaining how it all works. So property tax, and to take us through the ins and outs of that. Welcome, Sam.
Good evening, everybody. Pleasure to be here. Nice to be in face-to-face sort of networking again, rather than the whole Teams and Zooms events. So, yeah, good to be back in person now. There wasn't any sniggers. There was no laugh. Everyone's thinking, if that's SamHolloway, yeah, who's doing a presentation? It is me. It is me. I don't know if it's the landlord side of it that's aged me, the tax advice, or I think it's probably a couple of kids that have done it. But no, it is me. It is me. And I've been in a chartered tax advisor for 13 years, and bought my first rental property about 7 years ago. So got a bit of a double-edged sword for a reason to keep up to date with the tax. One, keep my job, and two, because I want to know the rules well, know what I can claim, because it will help me personally. Because of the landlord side of it, and being the tax advisor side as well, most of my clients are in property, whether it's rental properties or property development. And it's quite nice because it does mean that I don't tend to come across, it's fairly niche, so I don't come across too many queries that I haven't come across before. The most common from those getting started in property, little pitch, is certainly whether to buy via a company or personally. And actually it's a very complex area. It could be a couple of hours in reality if we really went into detail. But it does actually come down to two key areas. And it's what your future intentions are, and aspirations as well, and also the tax position that you find yourself in. So that's what we're going to be covering today. I mean, questions in this sort of format doesn't tend to work so well to say, anyone got any questions at the end, but we're all around afterwards for at least half an hour. Please don't leave me on my own doing nothing. Come and have a chat with me and ask questions. That's why I'm here. So starting off with the future intentions and aspirations, the question here is, are you looking to build a portfolio? So if your intentions are to just rent out one or two properties, setting up a company is unlikely to be the route for you. It still can be of benefit, but you've got accounts to do, there's company compliance work. So whereas if you own a property personally, it's a tax return or two. With the company, you've got company accounts which go to Companies House, you've got a corporation tax return to HMRC, confirmation statement, and all of that admin comes at a cost. So if it's just one property and you think, actually, I just want it to be on the side of my employment income, I'm not really building a portfolio, then actually stick with personal route. It's easier, there's less admin, you probably get better mortgage interest rates, depending on the type of purchase. However, if your intention is to grow a portfolio, and we're talking to get 3 or more properties in the next, say, 2, 3 or 4 years, we're not saying you're going to go out there and buy 5 this year. But if the long-term aim is growth, then that tends to support using a company from the outset. This presentation is only 15 minutes, so it is focused on from the outset. Now, there's options if you did already own properties, but they're a bit more complex. As in corporation, you can do all sorts. You can transfer the properties, but it comes with separate charges. The nice thing, if you actually haven't started buying yet, is you make the decision first, and you just follow that path forever. If you're buying personally and you're going to buy 1 or 2, do that. If you're going to use the company, then you just keep buying in the company. This was a little interesting one. This was from Companies House website. I mean, it's an incredible number. That's 47,400 buy-to-let companies incorporated in 21. So it does show you a lot of those people will be getting advice and they'll know what they're doing as well. So for that many people, and it could be several individuals involved with one company, it does benefit a lot of people to use the company route. Already 5 minutes through. I mean, that went quick. I'm going to have to speed up. So your tax position, this is by company ownership. So the key point here is the company that owns the property. So that seems like a straightforward concept, but it's the thing that probably I have to repeat the most, because the company owns the property, it's the company's money, and if you want that money, then you have to get your hands on it. Now, there's different ways of doing that, and I'll come on to that. But that's the key point. It's a separate legal entity is the key there. Now, profits in the company are currently subject to corporation tax at 19%. I'll come on to the personal tax rates, which are variable in a little while, and you'll see that they tend to be much worse. There is changes to the corporation tax rate from April 23. 19% still where your profits don't exceed 50,000. If your profits are going to be more than 250,000, so you've really grown a portfolio, tax rate is 25%. The bit between 50 and 250,000, the effective rate is 26.5%. It does take the shine off the company route a little bit, but it is still better. And many people, especially towards the beginning, that is profit, that's not turnover. So you're allowed all of your costs, and you'll be at 3-4 properties typically before you're getting anywhere near this figure. So this is the key, they're taking an income. So the rental profits belong to the company, and the question is, how do you get your money out? The initial funds put into the company, things like the deposit, you can still take them tax-free. So for example, say that an example earlier was a 200,000 property, 50,000 was put down as a deposit. You're going to need to, the company has no money, so you put 50,000 into the company to buy the first property. That 50,000, as and when the cash becomes available, you can just take it out tax-free. It's just a return of the loan. Beyond that, you've got various remuneration options. There's salary, dividends, provision of assets, and provision of assets can include things like an electric car, for example, but each of them comes with its own implication from a tax point of view, but the key is you're in control of it. So you're not going to unexpectedly walk into a salary tax charge or an unexpected higher rate dividend tax because you are the one making those decisions. The risk of the double tax charge is real though. So if you really are investing because you need the funds for personal use rather than leaving the company in there, so if every penny you make, you want to keep it, well that sides towards owning them personally because it's your money anyway. With the company route, if the profit stays in the company, there is no second tax charge. But if you do want every penny, you could find yourself in this bad a situation where you're paying 25% corporation tax on the profit, and whatever's money is left, you could end up paying dividend tax now as high as, that is the absolute maximum to be fair, but as high as 39.35%. So this is the key. If you're looking to grow the portfolio, build the money in the company and reinvest, then you don't get this second tax charge. So that is towards this route. I haven't covered it much, but one of the benefits is also family planning. Just because you own shares in a company, the fact that it is a company doesn't mean that it comes with all of the reliefs that come with a company. For example, business property relief, which is like an exemption from inheritance tax on your estate, doesn't work for rental companies. The value of the shares comes back into your estate just like the value of the properties would. However, it does make family planning easier. So if you have the scenario in a very straightforward world where you've got mum and dad who have got property and they want to pass a bit of the property on to now adult child, it's not that straightforward to say, well, I'll give you 30% of a property. Well, actually, it is relatively straightforward to say, well, I'll give you 30% of a company. Now, there's implications of doing that, but you can do it. So you can get family involved and start bringing them into the mix. So this is the personal tax position. It's never a good idea to put an example, because now what everyone does is just start reading through this. But start with this one for me, and that's just sort of a summary. So we were just looking at corporation tax rate of as little as 19%. What happens with the rental income in your personal name is it just gets added to your other income to determine what tax band you are. So that includes things like a salary. That will use up some of that allowance. Now, if your salary plus your rental income, and you are ignoring mortgage interest and things like mortgage arrangement fees, if the income from the property comes in that range, you're paying tax at 20%. If the income comes between 50 and 150 roughly, it's 40% tax. Income above 150 is 45% tax. So this is total income. So if you had a 50,000 salary, you've used up this really. You're paying tax at 40% on the profit, and you ignore the mortgage interest as part of that calculation to some extent. Whereas in the company, you're paying 19%. Full stop. That's it. It's a big difference. On top of that, you will lose your personal allowance if, say, for example, you already earn exactly 100,000 salary, you keep your tax-free personal allowance. If the rental income pushes you beyond the 100,000, you begin to lose your personal allowance. That earnings, anywhere between 100 and roughly 125,000 of earnings, has an effective tax rate of 60%, and we're getting into silly numbers at that stage. It's just in that range, 60%. Go a bit lower. If you're earning 50,000 and you get child benefit, you get property, and then you start getting rental income, you will start to lose your child benefit as well. You have to start repaying it. It goes on like a sliding scale, but the key is by the time you get to 60,000, you've got to pay all of the child benefit. That doesn't matter if you own the property and your spouse is getting the child benefit or vice versa. If one of you is getting child benefit and one of you has the property, it goes on the higher earners and you will lose it. So you can see it's more complex. You go, well, what's the profit in the company? Pay tax at 19%. You buy it individually. It's a mix of all different tax rates, losses of allowances and things. But still, if it's one property, just stick with it. You're going to lose a bit of the money in tax, but it probably isn't worth using the company route. You're not going to save enough in the company. This route, and this is a reality for some people, and I appreciate this is a long way down the line and this is getting started in property, so you're not going to be at gross rents of 400,000 particularly quickly, but the key is get it right at the beginning, and as you grow, you won't find yourself in what we have now, and in reality, we have people in this scenario. This is a tax computation in effect. The numbers are a little bit silly, especially if you're paying that on that gross rents. You need to speak to Vincent because the deal's not very good. 200,000 is a lot, but it helps to just make the point very, very clear. So what we've got here is gross rents husband and wife, no other income. Gross rents 400,000, deductible costs, things like your insurance, your repairs, your agent fees, 120. You ignore mortgage interest now. That is the rules. I mean, I'm referring right back here to 2016-17 as the old rules. That's how far back these rules are. So this may be just the norm for you guys now. But you used to be allowed to get the mortgage interest. You don't anymore. So you ignore the mortgage interest. Income over 100,000 each, they lose their personal allowances. So 280,000 is taxable. Get a bit of 20%, a bit of 40%. And then what you get is you get the 200,000 as a tax reducer at 20%. So you're getting taxed at 40%, no 45% here, so it could be worse. But you're getting a reducer of 20%, so the relief is halved. Net tax liability, 59,200, which is an effective tax rate of 74% on the actual income that you receive. So the money you get in the bank, 74% is gone. I have, or used to have clients, they've now incorporated, to be fair, but we had a couple of couples that were over 100% because they were so highly geared. That is the money they actually got in their bank account was less than the tax liability they were paying at the end of the year. They had no choice but to go for incorporation, which is a different subject altogether. So the company route skips your risk of this. Compare that figure, tax liability of 59,000. Company would be same here, minus 200,000 here, 80,000 profit, tax it at 19%, £15,200 instead of £59,200, 44,000 difference if you don't then need to take the money out of the company. So it's just trying to make it a very clear point here that how bad it can get. I think that will be, because my time is virtually there as well. That is pretty much it, guys. So it's a real rough and ready sort of comparison between the two scenarios. We've got some fact sheets outside. This is actually done particularly for this event. It compares in far more detail the difference between using a company and buying personally. And very happy to answer any questions afterwards. And please, don't leave them on my own.
Nice one,
Thank you.